Thinking about investing in commercial property, but not sure how to fund it? You're not alone. Financing is one of the biggest hurdles and also one of the biggest opportunities in real estate. In this episode, we're diving into the money side of things, from traditional mortgage and loan options to some creative, flexible, and potentially game-changing alternative financing methods that could open doors without draining your savings. Whether you're gearing up for your very first deal or scaling up an existing portfolio, understanding how to leverage capital wisely can make or break your investment journey. So let's kick things off with the traditional route, mortgages and loans. When it comes to buying commercial property, most investors turn to commercial mortgages. These are loans specifically designed for purchasing income-generating real estate like offices, retail units, warehouses, or even mixed-use buildings. Just like a residential mortgage, you'll typically need a deposit, usually 25% to 40% of the property's value, depending on the lender, the location, and your experience as an investor. The remaining 60 to 75% is financed through the mortgage. Now here's where commercial finance differs. Interest rates can be higher than residential loans, and the repayment terms are usually shorter, think 10 to 25 years. Lenders will also look closely at the property's rental income potential, not just your credit score. If the building already has tenants with long-term leases in place, you're more likely to get favorable terms. There are two main types of interest structures to be aware of: fixed rate, where your monthly payments stay consistent throughout the term, and variable rate, which may fluctuate depending on the Bank of England base rate. Fixed rates give you peace of mind, but variable ones might offer lower initial costs. It's all about balancing risk and reward. One key thing investors often forget: lenders typically expect you to cover more than just the mortgage. There are valuation fees, legal costs, arrangement fees, and sometimes even early repayment penalties. So always factor those into your budgeting. Now, let's say the bank says no, or you don't quite have that 30% deposit saved up. What then? That's where alternative financing methods come in, and this is where it gets interesting. First up, bridging loans. These are short-term, high-interest loans used to bridge the gap between buying a property and securing longer-term financing. Let's say you found a brilliant commercial space, but your mortgage application is still being processed. A bridging loan could help you secure the property fast. Then you refinance later with a traditional lender. The catch? Bridging loans can be expensive, so use them wisely. Then we have private equity and joint ventures. These involve partnering with other investors or firms who put up capital in exchange for a share of the profits. This is ideal if you have property expertise, or a great deal but not enough funding to do it alone. These partnerships can be formal or informal, but always get everything in writing. A clear profit-sharing agreement can save a lot of headaches later on. Another creative option is crowdfunding, yes, even in commercial real estate. Platforms like Property Partner or Crowd Property allow investors to pool their money to fund larger projects. It's a great way to get into bigger deals without needing hundreds of thousands upfront. You invest, the project gets built or refurbished, and you get a slice of the returns. We also can't ignore pension-backed investment, especially if you're thinking long-term. If you have a SIPP, self-invested personal pension, you can use it to invest in commercial property, tax efficiently. It's more complex to set up, but for many experienced investors, it's a smart way to put pension funds to work without dipping into current cash flow. And finally, there's seller financing, also known as vendor finance. This is when the seller agrees to accept payment in installments instead of requiring the full price up front. It's not super common, but in slower markets or with motivated sellers, it can be a win-win solution. So, to sum things up, there's no one-size-fits-all when it comes to financing commercial property. If you're looking for stability and long-term ownership, a traditional mortgage might suit you best. If you need speed or flexibility, bridging loans, joint ventures, or crowdfunding could open doors. The key is knowing your financial limits, your investment goals, and your risk tolerance. Always run the numbers, and don't just think about how to buy a property. Think about how to hold it, manage it, and ultimately exit with a profit. Next time, we'll be digging into the legal and regulatory side of commercial real estate, not the most glamorous topic, but absolutely essential to doing things right and staying protected. Catch you in the next episode, and remember, smart investing isn't just about what you buy, it's how you think.